back. So we have another week passed, and here we are, ready to go with the Financial Mirror once again. This week is going to be a fun one. I'm telling you, it's going to be a fun one. Hopefully it's very practical. Hopefully it's very applicable to your life. Hope everyone was able to tune in last week for the interview that we did with Dylan, and that you took a lot away from that home buying experience. And a couple of that, we went over a couple of common questions that home buyers tend to ask. And if you missed it, go check it out. It's currently available on Facebook, YouTube, and wherever you listen to your podcast. So take a minute, go listen to that. That was a great one, full of good information. So, this week is a special one. And that's because for so long, I've been talking about debt. I've been talking about how, specifically, credit card and personal loan debt and payday loans, etc. And how those have the ability to limit your ability to build wealth, right? So that's one of those things that it holds you back. It really holds you back from getting to where you want to be financially. So knowing that these debts can hold you back and limit you from being where you want to be is very important that we attack it head on. But you can see by the title of this, we're not talking specifically about debt today. And that's where I want this to sort of drive in and sort of resonate with you, that this is the episode that is going to be a little more technical, but bear with me, a little more technical, but give you a sense of actually how numbers can play a sense into your psychology of going at your debt. There's some good stuff here. I'm telling you, I was really excited when I was putting together exactly how I was going to present this topic. And it got me really excited because I've spent episodes talking about this debt snowball and this debt avalanche and this debt. That's kind of weird, right? Like debt snowball, avalanche, it all has to do with snow. I feel like that kind of makes like snow evil or something. I don't know, but just a weird thought I had. Debt snowball and debt avalanche. When we're talking about debt, we only are talking about snow. That's weird. Anyways, I don't know. Anyways, next time you see snow, just remember it's very symbolic of the people around you getting out of debt. That's something to remember. Anyways, back on track. I've talked about all these different strategies, and these are debt strategies, and they're there to get you out of debt. And once you're out of debt, that's when you can start to feel like this stress-free life, where life just sort of, this like burden of life comes off of you. Finances are not really a concern for you anymore. At that point, you're living, right? That's when people actually can start living, when they don't have the debt, they don't have everything sort of being a burden on them. So I want to build on it, right? I want to build, and this week I want to show you just how much of your monthly cash flow. So cash flow is how much money you're bringing in monthly, how much you're netting monthly, right? Like actual wealth building potential, right? I use cash flow as how much are you actually profiting each month after you've paid for everything. All of your expenses are done. It's sort of what you're netting each month. That's your cash flow. And I want to show you how interest, specifically, APR interest, is affecting that part of your life, that cash flow part of your life. I really want to show you how that is. It's mind-boggling. I'm telling you that when you see this and you put this into practice, you will see a huge difference in how you approach your debt, because there's a dollar amount, and every day that passes that you are still in debt is another day that you'll see. It's another day that you spent XYZ dollars on debt, and it's crazy. So I'm going to get to it. But if you're currently out of debt, and I'm speaking everything except your primary home mortgage, you're already one step ahead of people that are just getting started with this piece, right? So if you're currently out of debt, there's still value in this episode. And the reason why I say that is because 80% of Americans are still in debt. So if you're out of debt, there's an 80% chance the people you talk to, the people that you surround yourself with, are still in debt. So take the time to share this with them, or at least you'll get talking points from this, so that if they ask you for help, or they talk about, you know, their life with their current debt situation, you have talking points to point them in the right direction, and you always can point them back to this episode, right? So therefore, this week, I'm going to go over, like I said, the more technical side of debt. I'm going to walk you through everything that APR. So it's not just going to be an acronym anymore. You're going to understand APR. You're going to understand how it affects you. It's not just to be this thing that you see on your statement every month. It's not going to be this thing that just shows up when you're signing up for a credit card or a personal loan or whatever. And I'm going to show you how this plays into your monthly cash flow, and how to calculate that number for your financial situation to motivate you to get out of debt. So it is, if you'll bear with me, we'll get through this, the technical, the math, the everything, and you'll be happier knowing that you have the knowledge to take care of this. So without further ado, we're going to jump right in. So what is APR? What is APR? It's an acronym. I got it. But what really is APR? Simply put, this can almost be used interchangeably with interest rate. I have to say that it's not completely interchangeably, right? Because sometimes APR can bring in a couple of other things that does not specifically mean the interest rate percentage. But when we're talking about it in a sense of how we're going to talk about it today, I want you to think of APR. And most of the time, 98% of the time, APR can be used interchangeably with interest rate. So I want you to know that is you're almost on a surefire path to knowing that APR and interest rate, it can be used interchangeably. So what does it stand for? It stands for annual percentage rate. Simply put, it's just how much a company charges you to borrow money. So they charge you to borrow their money. It's their money. And yes, if you're using a credit card, you are borrowing money. Think about it. When you're buying something on credit or on your credit card, you're using money that the credit card, it's the credit card company's money that you're using. They've sort of made that purchase for you, and you're going to pay them back. So you're in essence, you're still borrowing the money, even though you're not really borrowing cash like a personal loan would be. So you can almost look at how much you're allowed to borrow as your credit limit. If you're looking at a credit card, how much is your credit limit? That's known as you know, the amount of money that lender or credit card company is allowing you to borrow. So I'm telling you, the most confusing part of APR is the fact. So what is APR is not confusing. The fact that's confusing is the fact that APR, that word annual percentage rate, the annual word throws this whole thing off, because it actually is normally charged monthly. It's not charged annually, right? Because if you saw annual percentage rate, you'd be like, oh, this is how much I'm going to get charged annually. No, technically you're charged monthly. Sometimes, in some cases, depending on what kind of what the lender agreement is for whatever it is you're borrowing, sometimes these are charged daily. So it's totally confusing. I understand, but we're going to get through it. We're going to break it down. You're going to have a good understanding of what this is and how it's sort of made up. So when you sign up for a credit card, how is your APR determined? How does that get determined? Well, in all reality, you as an individual, in the eyes of a lender or a credit card company or a bank or whomever, you have this like credit worthiness, and it's based off of your credit score, if you have one, and payment history. And lenders want to know that when they let you borrow money, or they let you swipe your credit card, or they give you money for a personal loan or a payday loan or whatever, that they're going to get their money back. I mean, in their eyes, it's an investment, right? We talk about investments on previous streams, but it's this lender is allowing you to borrow their money so that you pay it back. Now, if I let you borrow $20, I might be like, hey man, yeah, just pay me $20 back, next week. Someone that's out for profit, I'm not lending you $20 to profit off of you. I'm lending you $20 because, hey man, you need $20, man, I got you. I'll hook you up. You help me get through a struggle sometime. I hook you up. Bro, like pound it. But in a for-profit business like Capital One, if they let you swipe your credit card, they want to make money off of you. Like that's the whole goal. Their whole goal is to make money, right? This publicly traded company is they want to make money. They have investors that are investing in them, that they make money, that they're profitable. Like it's a business, right? So if you are a higher risk or your credit worthiness is not so great, which would show you had a higher credit score or a lower credit score or lower income or whatever, they're less likely to give you a great interest rate because, think about it. You're a flight risk for them, right? Like they might not get their money back. If you have a higher credit score, if you have higher income, you're going to qualify for a lower APR or lower annual percentage rate because you are a lower risk, right? The thing about the misconstrued part of interest rates is that you want the lower. The reason they charge a higher interest rate is because of the fact that they need to try to make their money back faster. So that's the higher interest rate because you're a higher risk. They want to make their money back faster so that if something happens and life gets in the way and you can't pay them, they have made most, if not all, of their money back. That's the whole point in it, right? So that's sort of how your APR is determined. Okay. So now here's the thing. APR is not one size fits all, right? So if you're thinking APR isn't that confusing just yet, this is where it gets confusing. So APR is not one size fits all. One shoe goes on the left foot, one shoe goes on the right foot. Like this is not cut and dry. And I'm going to tell you why. Because in all reality, there's 5 or 6, and I say 5 or 6 because I roll a couple of them together, but there's a couple different types of APRs out there. So for this episode, there's more than that, right? There's tons of APR types out there. But for this episode, I'm going to focus on the ones that are most common to the everyday consumer, okay? So first one, variable APR or adjustable APR used interchangeably. Pretty self-explanatory, but this is an APR that varies in the situation or meaning it can change, right? Normally when you see a variable or adjustable APR, this rate is normally based on this like base rate that lenders are currently charging, and this changes depending on the market. So you'll mostly see these when it comes to mortgages, like an adjustable rate mortgage or a variable rate mortgage or whatever. But you do sometimes see these on a credit card, so just be on the lookout for them. But the long story short of an adjustable or variable rate is that you get good rates sometimes, like in the housing market when COVID hit and mortgage rates really dropped. Someone that had a variable rate or adjustable rate mortgage truly benefited off of that without ever having to refinance or anything. Like they just kept paying their normal payment and they benefit off of that adjustable rate. The other type of rate is a fixed rate where when you sign up, you get this mortgage, you get approved for this loan or whatever. It has a fixed rate, like a 12% or 13% or 6% or 2% or whatever percent, and it's that. And there's a term which will show how long this is for, and an interest rate, and it's set, right? It's a fixed rate. So these can be seen on mortgages, but these are on more often on credit cards as well. One thing to keep in mind, though, when it comes to fixed rates, fixed APR, is that if you're late on a payment, the lender does have the ability to raise your rate. So it's clear that just because it's fixed doesn't mean it's always fixed. If you're an on-time payment, yes, it won't change. But if you're for whatever reason on a fixed rate and then you're late on a payment, you will end up having to eat the cost for that. It will shoot your rate up. The other type of APR is your purchase APR. This is that purchase APR. This is that interest that is charged to your credit card account when you don't pay your credit card balance off at the end of the month in full. Okay. Now, here's what I want you to, you're probably like, man, I pay my credit card balance off every month. Like, I just keep using that thing. I only did it for the airline miles. I only did it for the dining dollars. I only did it for the whatever your reason for using a credit card is. You're like, I pay it off every month in full. I don't get charged a purchase APR. Okay. Now, I'm speaking to the masses here. So if that is you and that's actually you, okay, I got you. But 47% of Americans actually pay off their balance in full. So knowing that, this is probably the APR rate that's affecting your monthly cash flow the most. If you're not paying your credit card balance, or if you're carrying balances over month to month, this is the one. This is the APR that is affecting you and your cash flow the most. Okay, so we're gonna get to it. How we can fix it, how we can really break it down, so I can show you how much it's affecting you. And that's what I want to end this with. I want you to understand how much this affects you. It's not just like this random percentage out there. Like, it has an actual dollar amount that goes with this random percentage. I want to show you how to calculate it for your situation so that you know exactly how much you're wasting. I mean, it's wasteful. You're literally throwing money to these for-profit companies and making them rich, right? So the next type, we got two more. Well, 2 to 3, depending on how you want to roll into the last one. But the next to the last is cash advance APR. This one I'm not going to go into very much deep detail because it's where you take a cash withdrawal on your credit card and you're charged this rate, normally higher than your normal purchase APR rate for that cash withdrawal. If you've ever done this before, you know how painful a cash advance APR is. If you've never done this before, a cash advance on your credit card, please never do. That's all I'm saying. Please never do a cash advance APR or cash advance on your credit card to where you get hit with that cash advance APR. It's painful. So don't do it. Introductory and balance transfer APR. I'm going to lump these two together because they kind of go hand in hand. So the introductory APR is normally like a 0% for the first 3 months kind of offer. This is ultimately you have an actual purchase APR, maybe like 16% or 12% or whatever, but that doesn't kick in until your 0% for the first 3 months is over. All right. This is how companies rope you in. This is how companies get you to sign up for their credit card. They're like, oh, we'll give you 0% for the first 12 months. And you're like, wow, I can buy all this stuff and not pay any interest on it. This is amazing. Here's the catch. You have to pay this card off, normally with an introductory rate. You have to pay that off in full before the time is up, or you'll get slapped with an interest charge for the whole 12 months for the whole purchase. Okay. So if you don't pay it off before your 12 months is up, you get slapped with interest for the whole 12 months. Even if you paid off most of it, you get charged for it has to be paid off in full, most of the time. Now, it's not always the case. So every lender is different, and that whatever agreement and introductory offer you sign up for, totally different. But be on the lookout for that, because people may, they normally spend more money when they have that freedom to 0% for 3 months. They have that freedom. They spend more money than they normally would spend at a normal, without that credit card. So that's very important to look at. And companies are making loads of money off of you. If you're getting suckered in to these introductory offers, and you're not cautious and playing it very cautiously, you're getting suckered out of loads of money. Okay. Now, the next one. All this is also true with a balance transfer APR. What that is normally you have this high interest rate account, let's say like 24% interest rate on a personal loan. What the balance transfer does allows you to move that 24% loan or personal loan account over to this credit card that, if paid in full, is 0% APR for 18 or 24 months or whatever it is, 12 months, 18 months, 24 months, whatever it is. And the plan here is that you transfer that high interest account over to this credit card. You balance transfer over to this credit card for this 0% for whatever the term is, right? With the idea that you're going to pay that off and you're going to be debt free and no more debt. Now, if the plan always went like that, would the lenders still offer it? Well, the obvious answer is no. Why would they continue to offer something that is not making them money? If everyone was that responsible, they would stop doing it because it doesn't give them any value, right? So is this actually working? Well, for some, maybe. But for the most part, of course not. The banks and lenders are making tons of money off of doing this. So it's not as surefire as you would think. Could it help some? Yes, of course. There's definitely things out there that can help some more than others, but ultimately you've got to know that this is not the surefire way to get yourself out of debt is to do a balance transfer. So let's just clear the air on that. That's that. Okay. So I'm going to bounce over to my desktop. For anyone listening to this on a podcast, I'm going to verbally go through this step by step, this calculation. I'm going to verbally walk you through it. So don't think you're going to be left behind if you're listening to this on a podcast. All right. So here we are. We are loaded up. We're booted into the spreadsheet. I'm going to make these numbers big so everyone can see it. For anyone that's watching live, if you're not watching live and you listen to this on the podcast, like I said, I'm going to walk you through. Can I only go to 200? Okay, cool. So I'm on 200. Oh, let's do this. I can do this though, can't I? Let's make our font bigger. Boom. Look at that. That looks great. So if you are watching this on the podcast and any of this doesn't make sense as I'm going through it, always, please just go look at the Facebook or YouTube channel, or just go to thefinancialmirror.org and check out the video, and it'll walk you through sort of this calculation. But I'm gonna verbally read it off as I'm going through it. So if you are listening, this should all make sense. And you should be able to go home and, reproduce these results. But if not, always just tune back in to the stream on Facebook or YouTube or the website, and it'll walk you right through it. Just cut over right to this one part where we're talking about the APR calculation, and it'll walk you right through it. So this is where we're going to actually put a value on the monthly cash flow that you're giving away to lenders that could be going in your pocket. Okay. So when this is all said and done, take the time and do this for all of your accounts. Every account that you have that you're paying an interest rate on, this can truly motivate you to stop just giving your money away. Because right now you're like taking money out of your wallet and literally giving it to these companies, making them very wealthy. I mean, you're putting a lot of that money into other people's pockets. So please take the time, do this for your account, and you'll thank me. It'll motivate you to stop giving your money away. Okay. So first, 5-step process. I'm going to walk you through it. Very easy to go through, and figure out what it is exactly that you're doing. So first off, identify what your APR is. So go look at, this is step one, go look at your account and find out what the APR on your account is that you're calculating for. Okay. So for our example, I've got on the screen, APR is 15%. So the APR for our account, and we're just going to say this is our Capital One account, is 15%. Okay. So that's step one is just go and find out what is your APR. And this should be something that is known, right? You should just know what your APR is. Okay. So step one, pretty easy. You can go look at your statement. You can go look online, go to your app or whatever, and check out what your APR is. Okay. Step two that I want you to focus on is you've got to find out what your current account balance is. Okay. So current account balance for this example, and while you're looking, so for step 1 and 2, pull up an account statement, paper statement, whatever, online statement, your login on your computer, on your app, whatever. Find your APR. It should be a percentage. Find your statement balance. How much your total balance that is currently due. All right. If you haven't used the card, it's going to be your total balance. If you've used the card, you're going to have a 30-day delay on your purchases. So if you're trying to get out of debt, stop using the card first off. So let's just clear the air on that. Stop using the card. Use a debit card or cash or whatever. But stop using the card if you're trying to get out of debt. It's only going to make this harder. But if you're using the card, or if you're not using the card and you're trying to pay this off, identify what your APR is. 15% in our case here for the example. Current account balance. Find out what that is. For our example today, I'm using 5,897. Now, why did I choose that? I chose that because that is the average balance on credit cards at the end of 2020 according to Experian. So according to them, the average balance on credit cards at the end of 2020 was 5,897. So that's where that number came from. Because I wanted to make this as average as can be. Okay. So we've got that. So step 1 and step 2, find your APR, find your statement balance. All right. So step 3, this is where the math actually gets started. We've got to convert 15% into a daily percentage. It's pretty easy for that. All you're going to do is take your 15% and divide it by the number of days in a year, which is 365. Okay. So we're going to take 15% and divide it by 365. In this case, the number is 0.00041 something. That's far enough. Very, very small percentage is how much is getting added daily. So all we did was take the 15% APR for step 3 and divide it by the number of days in a year. Okay. Pretty easy, right? Now, this is where it's a little different. So that's just a percentage. So it's mess that up. So let's do this again. And this is just on my end. No, the math is still correct for anyone that's listening. Let's make sure this is make sure this comes out. Yeah, okay. So now step 3, divide 15% by 365 days in a year. That's going to give you your daily percentage. That's how much you're paying percentage per day. Okay. Now we need to convert that percentage into a daily dollar amount. So how much are you spending daily on this statement? So our 5,897. So what you're going to do is you're going to multiply your statement balance, 5,897. You're going to multiply that times that daily percentage rate. That's going to give you your daily dollar amount. So in this case, for our example here, is $2.42. So every day that I carry this balance on this Capital One credit card, I'm giving away $2.42. Okay. So I'm going to break this out into a weekly amount, a monthly amount, and a yearly amount. Okay. So weekly, now you have that daily amount, right? You have the daily amount. The daily amount is $2.42. And if you, like I said, if I lost you in the math and you're listening to this on the podcast, don't fret. Just go to YouTube, Facebook, and watch this one singular part of the video so you can see how we did this. Now, but if you followed along verbally, you're going to still notice all this is probably making sense, and you're going to rock right through it. We got our daily percentage. We got of that statement balance, 0.04%, and we multiplied that times the statement balance to give us the daily dollar amount, which is $2.42. So this is the total amount that of an actual dollars, like physical dollars, that your account is increasing every day you don't pay it off. Okay. And you're giving that money away. That money is just going away. Okay. So that was step 4. Convert that percentage to a daily dollar amount. Now, step 5. So we're pretty much done, right? Like there's really only 4 steps. But if I look at $2.42, I mean, it doesn't really hit me that much, to be honest. Like I'm like, oh, $2, like $2.50, roughly a day. I don't really think about that, like it's $2, man. I find $2 under the sofa cushion, so I mean, it doesn't really make sense to even really fret about that, right? Wrong. So let's convert that. Let's give you the weekly, monthly, and yearly amount. Let's really put some emphasis on this thing. So we're going to multiply that $2.42 by 7 to give us the weekly amount. That puts us at $16.96 a week that we're giving away. Put that into a monthly amount. We're going to do $2.42 times the days in a month. That means it's $72.70 a month that you are wasting by carrying this credit card balance. $72.70. This is $72 a month I am wasting. Okay. $72 a month. Now, a year, right? So let's take that same daily amount and multiply it by the amount of days in a year. We are wasting $884.55 a year just by carrying this balance. Okay. So yeah, that's a pretty substantial number right there. $884.55 is a pretty substantial number, right? So this, like I said, this was a pretty easy little spreadsheet I built out here. Like I said, check it out on the stream if you want to see how I built out this spreadsheet, because then you can go through and just fill out your what's it called, your APR and statement balance, and like if you're at a 17% interest rate, the math would all change for you, right? So 20% or whatever. So whatever your APR is, like that, you can just use this as a calculator and plug them all of your statement balances and APRs to get what these numbers actually are for you. So for multiple accounts pretty quickly. So take this very simple 5-step process and come up with how much you're giving away each month, each year that could be positive cash flow for you. Okay. So in conclusion, I'm going to leave this up. I'm going to leave this up right here so you can visually see this as I'm going through this. In conclusion, I know this episode was full of math. I mean, you can see it on the screen. It was full of math. I got it. Terrible. Yuck. Math. I got it. Understand. People hate math. A lot of people hate math. I don't hate math, but a lot of people hate math, and that's fine. This simple math right here is a crucial piece to see the magnitude and impact of how APR, interest rate, is draining your cash flow. Okay. If $72 a month is not, a wake-up call that you're just giving money away, $884 a year that you're just giving away, I mean, that's truthfully a large sum of money. Okay. And to be honest, I had to look this percentage up because I was like, how many people actually even know what their APR is? To be honest, only 39% of Americans actually even know what their APR is. That's not good. That's really not good, because this shows you that that most don't realize the magnitude that that simple number, that simple little percentage has on their financial outcome. So what can you do? Like, great question. I'm so glad you asked. What can you do? Well, the first thing I truly want you to do is use this 5-step process that we just went through to come up with what your number is, that tangible dollar amount that you're wasting by carrying a balance month to month to month to month. Okay, so go find that out. The next thing I want you to do is I want you to make an effort to try to get in touch with your lender to actually ask them to lower your APR, right? Because you could lower this APR. For anyone that's looking on the screen, I dropped the APR to 10%, and my total amount that I'm saving a year went from $884 to $589. So $300 by dropping 5% on the APR. Will you get a 5% drop? Maybe, maybe not. Who cares? If it's a 1% drop, it's 1% more that you didn't have to waste. So for personal loans, auto loans, mortgages, this is not easy, obviously, right? For those, is it possible to move these type of debts to a lower APR? Yes, it is. But is the juice worth the squeeze on that? Probably not. Case by case basis. I'm not a financial advisor. I'm not here to give you financial advice. I'm here to show you facts and let you decide what's your best approach for that. For credit cards, this is 100% easy and can be done in less than 30 minutes. Depending on the on hold time for your credit card company, for how long you're physically on hold on your call, that's the only thing that's really adjusting this time to the left or right. Now, this isn't a guarantee by any means that you're going to get a lower APR. It's like an old saying goes, the worst they can say is no. Give them a call. Doesn't hurt to try. And don't be upset if it doesn't work. It was worth your time still. So give them a call and tell them, hey, I'm current on my account. Hey, I've been making on-time payments. I'm regularly paying my bills. Can you drop my interest rate for me? Just asking nicely, right? If they say no, don't be mad. It was worth a shot. But if they do say yes, you can see this can really save you some money. So in closing, I want you to know APR is not just 3 letters. It's truly not just 3 letters. It's not something that you're told and you forget about. This truly plays a role, a huge role, in how you end up financially. So if you're living paycheck to paycheck, that $72, for example, is probably a wake-up call, because you're like, wow, $72 extra a month would be nice for anyone that's in the situation of paycheck to paycheck living, right? So don't wait another day on this. Take control of your finances. It's really up to you to take control of your financial outcome. It's truly up to you. I mentioned before, 80% of Americans are currently in debt. And so do me a favor, take a moment, share this video, share the podcast with 2 of your friends or family members that can truly benefit off of this, that needs that little wake-up call, that little nudge to just say, let me show you how much you're actually wasting by carrying over that balance. Because I really want to help as many people as I can achieve this life where finances are not really a burden on their life. They feel a little more free, away from just this financial stress, right? So as always, if you're in need of a financial coach, I'm here to help. Would be glad to help. Just go to thefinancialmirror.org/contact. Send me a message on there to connect, and we'll get something worked out so that we can get you started, and I can be there with you step by step, day by day, walking you through this journey to get you where you want to be. So thanks for tuning in, and I'll see you next week. Peace.